Right now, in Tokyo, a guy you've never heard of could be helping set the price of your mortgage. Yeah, that sounds ridiculous, but it's not. And here's the wild part. This quiet decision maker may matter more to your borrowing costs than the people screaming on TV about the next big crisis. Not AI, not China, not whatever drama is bubbling in Washington this week. Something way more boring. A Japanese government bond. I know. That's not exactly a sexy headline. But for decades, that bond helped hold the whole global money machine together. And now, in 2026, that thing is starting to crack. So if you've been wondering why mortgage rates feel stuck, why markets keep twitching for no obvious reason, and why the obvious explanations never quite fit, stay with me. Because the real pressure point isn't where most people are looking. And yeah, it's in Tokyo. To get why Japan can mess with your mortgage, we have to go back a bit. Picture Japan in the early 1990s. The economy had been on fire until the bubble burst. Real estate tanked, stocks tanked, growth vanished, wages stalled. Inflation basically disappeared. The country slid into what everyone now calls the lost decades. Imagine hitting pause on an entire economy and then misplacing the remote for 30 years. So the Bank of Japan did what central banks do when they're out of tricks. It cut rates to zero. Then it pushed them below zero. Then, when that still didn't do the job, it rolled out yield curve control, which is a very fancy way of saying we're going to pin long-term rates down no matter what the market wants. In plain English, Japan didn't just lower rates, it stapled them to the floor. And I know, from the outside, that sounds like ancient history, like some dusty economic museum exhibit. But, that setup quietly shaped the world you're living in now, including the rate on your mortgage statement. And it created a very specific problem for Japanese institutions that had to manage real money.
Let me give you a character so this makes sense. Let's call her Yuki. Yuki runs money for a huge Japanese pension fund. She's in charge of making sure millions of retirees get paid, year after year, without excuses, without drama, without a sad little shrug at the end of the quarter. Her job is not complicated, but it is brutal. And the issue is simple. The safest bonds in Japan barely pay anything. Basically nothing. So Yuki has two choices. She can keep everything at home and earn almost zero while explaining to retirees why their money isn't growing. Or she can send some of that money somewhere it actually earns a return. You can guess which one the professionals picked. Here's the move that ran the world for years. Borrowing yen, where it's cheap because Japanese rates were glued to the floor. Convert that yen into dollars. Buy US government bonds that pay 4%, sometimes 5%. Borrow low, invest high, keep the spread. That's the yen carry trade. And it wasn't just Yuki. It was pension funds, life insurers, banks, hedge funds. Basically anyone with a pulse and a thirst for yield got involved. For 30 years, this trade became one of the biggest engines in global finance. At its peak, estimates put it in the trillions. Trillions, with a T. That one setup helped feed cheap money into markets all over the world. It supported asset prices. It made borrowing feel easier. It kept demand for US debt strong. And all of it depended on one giant assumption. Japanese rates would stay near zero forever. Forever is a dangerous word in finance. And in 2024, that assumption finally broke. Japan got the one thing it had spent decades trying to create: real inflation. Prices started rising in a way that actually mattered. And once that happened, the Bank of Japan could not keep pretending rates should stay frozen while people's buying power got chewed up. So in 2024, it ended yield curve control and raised rates for the first time in 17 years. Then it raised again.
And again. By the time we get to 2026, the policy rate is around 1%. To Americans, that sounds tiny. To Japan, that's a 30-year high. That's not a small move. That's an earthquake. And once Japan started hiking, the old math behind the carry trade started flipping upside down. Because now borrowing in yen costs real money. Currency hedging costs more too. And suddenly that nice US Treasury paying 5% doesn't look so juicy after all once you subtract the new costs of holding the position. The free lunch wasn't free anymore. And when a trade built on free money stops being free, people don't slowly stroll out the door. They run. We already got a preview of that. On August 5th, 2024, the carry trade basically had a panic attack. Japan had just hiked, a weak US jobs report hit at the same time, and the yen jumped hard. That's terrible if you're sitting on a trade funded in yen, because now the thing you borrowed got more expensive to repay. So everybody tried to unwind at once. Japan's Nikkei dropped about 12% in a single day, worst day since 1987. And that wasn't just a Japan problem. Trillions in market value got wiped around the world in roughly 72 hours. The S&P 500 got dragged into it too. For a few days, it felt like the floor had disappeared. Then it steadied. People exhaled. The headlines moved on. And of course, the internet went back to obsessing over Nvidia. But that wasn't the end of the story. That was the warning shot. Because the unwinding of the carry trade is not just a one-day stock tantrum. It's a sign that something bigger is shifting underneath the global system. Some of that money is starting to come home. And there's a word for that: repatriation. That's the part that matters. For 30 years, Japanese capital kept leaving the country in search of yield. Now, the incentives are changing. If you're a Japanese institution, why keep chasing returns halfway across the planet when your own government bonds finally pay something at home?
No currency risk, no borrowing gymnastics, no foreign exposure just to make a few extra basis points. You can stay local and earn. That's the open loop from the beginning, so let's close it. Why should you care about a Japanese money manager you'll never meet? Because when institutions like Yuki's start bringing cash back home, two huge things happen. First, they sell some of the long-dated Japanese bonds they no longer need as aggressively, and yields on those bonds rise. The 30-year and 40-year parts of the curve have already been flashing stress. Second, and way more important for you, America loses one of its biggest and most reliable buyers. Here's the part a lot of people never realize. Japan is the largest foreign holder of US government debt on the planet. Not China, Japan. For decades, Japan was one of the steadiest sources of demand for treasuries. It was like having the same customer walk into your restaurant every day, order the same thing, and never complain. Comfortable, predictable, beautiful for the people selling the debt. Now imagine that customer starts showing up less often. That's what this starts to look like. And it's not just one fund making one trade. Japan has long been the world's biggest net creditor nation. Its pension systems, insurers, and institutions sit on mountains of foreign bonds, including a huge chunk of US debt. For years, the money only flowed one way, out. But starting in 2025, there were stretches where Japanese investors became net sellers of foreign bonds. That matters. At the same time, those long-dated Japanese bonds have been throwing off record-high yields because buyers now want more compensation to hold them. So the quiet corner of global finance that everybody ignores? Yeah, it's sparking. Now, why should you care if one major buyer steps back? Because the bond market is the plumbing underneath everything else. Ray Dalio has been screaming about this for a while, and for once, he's not being dramatic.
His point is simple. Bond markets set the backbone of the financial system. They influence the risk-free rate, which then affects stocks, houses, retirement accounts, valuations, the whole ecosystem. When the bond market gets imbalanced, you usually see the same symptoms pop up. Long-term rates rise. The currency weakens. Gold tends to get stronger. And if debt dynamics get bad enough, you can get a self-reinforcing spiral where borrowing gets more expensive, which worsens the debt burden, which makes borrowing even more expensive. That's the kind of thing that deserves way more attention than it gets. And here's the key mistake most people make. They obsess over the Federal Reserve. Jerome Powell gets treated like the only person in the room. But the Fed mostly controls short-term rates, overnight money, the front end. The long end of the curve, the 10-year, the 20-year, the 30-year Treasury, that's driven more by supply and demand than by one press conference in Washington. How much debt is being sold? How many buyers want it? That's the real game. And right now, the supply side is ugly. The US is running deficits around $1.75 trillion a year. The total national debt has blown past $37 trillion. And in 2025, Moody's finally stripped the US of its last perfect credit rating. So now the Treasury has to sell a staggering amount of new debt just to keep everything moving. At the same time, one of the most dependable buyers is backing away. When supply rises and demand softens, there's only one way to clear the market. You pay more, which means yields on long-term treasuries have to rise. The 30-year is already hovering around 5%, which used to sound almost absurd. And when long-term rates stay high, this stops being a bond market story and turns into an everything story. Let's make it real. Start with stocks. When analysts price a company, they discount future profits back to today using long-term rates. If those rates go up, the math says future cash flows are worth less right now. So even if the business is fine, even if earnings are solid, the valuation can shrink. That's why the market can get wobbly even when nothing bad happens. The bad thing is the rate sitting underneath everything. Now, mortgages. Mortgage rates track the 10-year Treasury pretty closely. So if long-term yields refuse to drop, mortgage rates don't get much relief either. That's the answer to the question people keep asking. Why won't mortgage rates just go back to 3%? Because if global demand for US debt weakens, the floor under rates moves higher. Think of someone trying to refinance a home they bought at 7%, waiting and waiting for some miracle drop. She keeps checking the Fed, like the Fed is the only thing that matters. It isn't. Her rate relief may be getting decided in Tokyo by a pension manager who simply decided to keep more money at home. And it doesn't stop at housing. Look at corporations. In 2020 and 2021, money was so cheap, companies borrowed like there was a clearance sale on debt. A lot of that borrowing is now maturing, which means it has to be refinanced in a world where rates are much higher. There's a wall of corporate debt and commercial real estate loans rolling over in the next couple of years. Every dollar of it has to be replaced at today's costs. That gets expensive fast. And when financing gets more expensive, companies pull back. They hire less, they invest less, they take fewer risks. Credit is the bloodstream of business, and the long end of the curve is its blood pressure. If you want to understand the pressure in the system, that's where you look. Now, I want to slow down for a second and be fair, because this is not some dramatic everything blows up by Tuesday prediction. Japan moves slowly, painfully slowly. The Bank of Japan is not the kind of central bank that wakes up and decides to nuke the world before lunch. Japan still holds a massive amount of US debt. It is not dumping all of it overnight. This could absolutely play out as a slow leak over many years instead of one giant pop. Honestly, that's probably the more likely version. But here's the thing about slow leaks. Direction matters more than speed. If the biggest buyer that showed up reliably for decades starts becoming a less reliable buyer, that trend doesn't need to be explosive to matter. It just needs to keep going. And that means the cost of money can stay structurally higher than investors got used to during the era of ultra-low rates. That's the part that gets ignored in the flashy headlines. Because this story is not clickable. It doesn't scream. It doesn't fit neatly into a 20-second clip. Nobody's going viral over Japanese institutional capital repatriation dynamics. It's too boring. And that's exactly why it matters. Instead, people keep telling themselves the same comforting story. The Fed cuts, everything gets better, liquidity always returns. Someone somewhere will always buy the debt. Nice story. Not a guarantee. So what happens if the biggest foreign buyer of American debt quietly steps back and keeps more money at home? Liquidity tightens. And liquidity is the oxygen in markets. You don't notice it until it starts getting hard to breathe. When that happens, it doesn't hit just one place. It hits the price of money everywhere. Stocks, mortgages, jobs, retirement accounts. And the people who pay the price are almost never the ones who paused it. The hedge funds will be fine. They always seem to be fine. It's the family that finally scraped together a down payment and now can't make the monthly number work. It's the small business owner whose credit line got more expensive without warning. It's the person 3 years from retirement watching their portfolio shake for reasons nobody will explain in plain English. That's the part that bothers me. The bond market never has to raise its voice.
It just changes the price of money underneath everyone and walks off like nothing happened. And that's really why I talk about this stuff. Not the shiny headlines, not the loud risks everybody's already screaming about. The quiet stuff, the unglamorous stuff, the boring stuff that actually moves your life. So if you want to understand the forces that are shaping the market before they show up in the mainstream story, hit subscribe and turn on notifications. Because the loud risks usually get priced in. The quiet ones, those are the ones that sneak up and hit first. So yeah, brace for impact.